Hey, future HFAs. So in this module, we're going to go over the financials of a nursing home. We're going to look at the income statement, the balance sheet, the statement of cash flows. Then we're also going to dive into the chart of accounts and the general ledger. As always, we're going to approach these topics from the perspective of a health facility administrator, not an accountant. So let's dive into it. All right, gang, let's get into it. So typically, a set of financials is considered the income statement, the balance sheet, and the statement of cash flows. And that's pretty much what's considered the financials for any company. So, why should we care about the financials of your nursing home? Well, the same as we would for any business, it helps us assess the fiscal health of our facility or of our business. Now, related to post acute care, that directly correlates to the resources you have available to take care of your residents. And also, it should allow you to see how the resources are being used, right, in your day to day operations. Specific to the income statement, the variance to budget category, which is typically a separate column within the income statement, is critical. Now, within this, we're assuming that you have a budget that was done effectively and appropriately, and it has provided you with a fiscal plan for the future. Assuming that, the income statement and the variance to budget column should be a pretty quick indication that are you meeting that financial plan? And it's not just about making money. The the income statement and finding those variances, that budget should have budgeted labor hours, budgeted raw food expense, things that are resources that should go to taking care of patients. Finding those variances on the income statement can directly correlate to your operations and what you need to do on a day-to-day basis, and we'll get into that. I actually do know of one. They're no longer in business, but they had 8 nursing homes, and they just didn't do financials. I don't think it was intentional. I think that they contracted with a back office company, and I think they were doing them in house actually. Then contracted with a back office company who wasn't able. I think they kind of oversold themselves. Then went to another back office company, but by then, they were a year and a half into operations, and the back office company they contacted was doing a lot of catch up work. And by the time they got caught up, the operator had to sell. And that's because without doing financials, even if at the end of every month or quarter or biannually or yearly, even if you're cash flow positive, you're able to pay your vendors, what you have coming in cash wise is appears to be more than what you have going out. Without understanding the whys and the details and your financials to be able to understand the whys and the details, you're basically a ticking time bomb. In retrospect, what happened with that company, and I learned from a third party, was they purchased these buildings, and the buildings were cash flow positive, had good financials, but that was because of uh, his, uh, some rates related to their Medicaid reimbursement that was in the past, and over time, the Medicaid rates fluctuate, and because they weren't doing their financials, they weren't tracking it. By the time they realized that they were cash flow negative, they were so far in the rears to being able to fix the reason that Medicaid rate that there was nothing they could do, and they ended up selling. So, why do I bring that up? Well, they didn't take very good care of their patients, right? When you sell a building, there's a lot that goes into it, and you're putting a lot at risk with the new operators. So it's not just about profit and profitability, it's about taking care of these patients. Being fiscally responsible is a big part of that, and managing your financials is how you are fiscally responsible. So let's dive into the income statement a little bit deeper here. So the income statement can go by a couple different names, really just a matter of semantics, and oftentimes based upon the ownership structure of the company. Is it a non for profit? Is it for profit? Is it a C corporation? So the income statement can also go by statement of operations, profit and loss statement. It's a matter of semantics, but at the end of the day, the important thing to take from the income statement is that the income statement should show all of your revenue and expenses over a period of time. And that's the key difference. The income statement is over a period of time, like a month, or a quarter or annually, and the balance sheet is a snapshot in time. And we'll get into that in a later slide. The income statement typically follows a very simple equation. You typically have your revenue on the top side, then below that, you're going to have your expenses. You take your revenue minus your expenses, you get your profit. Now, that's an oversimplified version because in nursing homes, we have contractual allowances, we have ancillary services, we have bad debt. But ultimately, for the purpose of this course, that in essence is your equation for the income statement. And I think that's what's important to take from this when you're in the position as an HFA reviewing your financials. What revenue are you bringing in and what makes up that revenue, which we've covered. By now, you should know Medicare revenue, Medicaid revenue. Within one component of revenue like Medicare, is it because of your population, your Medicare days? Is it because of the rates, meaning take those days times the rates, that's your Medicare revenue? Where are you compared to budget with those components? On the expense side, typically the expense section of the income statement is divided into components like the labor component, labor related component, operating expenses, fixed expenses, and your bottom line. There's no point in getting into the weeds with this for this course, but what you should take from it is with the expenses, you're going to have operating expenses, and then you're going to have non-operating or fixed expenses. The reason why that's important is because when you take your revenue and you subtract operating expenses, what you have left is your operating profit, your profit from operations, from doing your core business. What is your profit? And the reason why that's important, and here I do have one real world example of how this was critically important, the difference between operating profit and your pure bottom line, is there was an ED that he worked for a company and he had a new RDO. And the RDO's core buildings were across multiple states, which means he did a lot of traveling, probably implied that the regional director of operations, who was over the 8 buildings across multiple states, probably wasn't super in tune to each building because he spent a lot of time on the road, very heavily relied on the executive directors of each building, which is fine. You probably prefer that than have an RDO who is just involved micromanaging your building. But my point is, this ED's bonuses were based upon bottom line profit, and he just wasn't making bottom line, and he didn't have full exposure to the income statements within this company, but he did get some basic information, and he was struggling to understand why his operating profit appeared to be good, but he was never making the bottom line objective. So hang with me. So in the income statement, you have your revenue, and then you have your expenses. Okay, and then what he was seeing was bottom line profit, and it was just never at expectation. So he finally asked, to get more detail, and the RDO, gave it to him, and he found out that his specific building was highly leveraged and its debt service was astronomical, meaning you take the revenue, what you bring in, you subtract your operating expenses, and what you have next is your operating profit, the profit from your core business. In this case, that was good. He was doing well by that metric. But because they had so much debt and they had to service that debt, basically think of it as a really high mortgage payment. When he went from operating profit down to bottom line profit, That's where there was a big change because every single month he was paying, I think it was like 80,000 to service his debt. And that encompassed the lease payment and then the interest. And really, there was nothing he could do in operations to overcome such a significant amount of um, fixed expenses. Every month, no matter how many patients he had, no matter how great his rates were, no matter how good he did at managing his operating expenses, that fixed expense of, like I said, I think it was 80,000, was really making it almost impossible to make the pure bottom line profitable. I bring it up because without him and I talking, without really going through that, he, and I don't even know if his RDO really knew, because I think his RDO was just looking at the metrics given to him by corporate and seeing that, hey, this building's not making bottom line. Without having some basic understanding of the income statement, how it's made up, it never would have came to light that he was actually doing a really good job in this nursing home. His operating profit was better than the other buildings in his region, but that specific building was leveraged to buy other buildings, therefore its debt service was really high. So what was a really good operating profit then go down to pure bottom line didn't look so good. The reason why I bring it up is because that's a real example. Like this guy's bonuses were tied at that time to bottom line profitability. And he had an RDO who had a sizable region who really wasn't that in tune. So, every quarter, this guy's not getting his bonuses because his RDO is just looking at a checklist and, oh, well, you didn't meet your bottom line profitability. Well, without knowing and understanding the income statement and diving into it, you know, honestly, the guy could have lost his job at some point because it looked like on the surface he wasn't meeting bottom line. He had the only building in the company that was leveraged the way it was to have that high of a debt service. So, basic understanding of your income statement is key. All right, gang, let's talk about the balance sheet of a nursing home. So, the balance sheet is the second component of a set of financials, and the balance sheet you probably will work with a little bit less, but it's still an important financial to understand and have a basic understanding of what it is and why do we have them. A key difference between the balance sheet and the income statement is the balance sheet is a point in time, whereas if you remember, the income statement is over time. So you'll have an income statement, say, for the month of January, and although you could have a balance sheet for, say, January 31st, typically the balance sheet is year over year. So most commonly, the balance sheet will be as of 12/31 insert year. And what you would do is compare, say, the balance sheet for 12/31 2022 with 12/31 2023 to see how those components within the balance sheet have changed, and then try to understand why they changed. The balance sheet equation is pretty simple. I don't think it's as straightforward as the income statement equation, but it's similar. The balance sheet equation is your assets less your liabilities equals your owner's equity. And similar to the income statement, there could be some different names with that owner's equity section of the balance sheet. It depends upon the ownership of the company. But for the purpose of this course, just owner's equity will suffice. And what is an asset? Well, an asset is simply something that the nursing home owns or has the right to that is expected to provide a future economic gain. And that really is what separates an asset from a liability. A liability is the opposite. It is something that the nursing home owes or is liable for that should be a future obligation. And there are some really basic examples to help us kind of keep those straightforward. But when we take the assets minus the liabilities, what we have left is your owner's equity, the equity of that company. Within the assets will be divided into current and non-current. Some assets you think that you're going to have some type of economic gain in the near future, within 12 months. That's a current asset. Some assets are non-current. there should be an economic gain in the future, but it's more than 12 months. The best example of an asset, I mean, if you owned any company, whether it was a nursing home or if you own Google, the most important asset would be cash, right? That's the clearest example of an asset of a company that you can really expect that cash will give you some future economic gain, right? There's a lot you can do with cash. Why it's an asset. At the same time, patient receivables is a very common asset. We work in, and the reason why that's really important is because, in the healthcare setting, as you guys already know, it's a very retrospective environment, right? We talked about before how, unlike Starbucks, where you go and you give them cash and they hand you a coffee, healthcare is not like that. We provide a service and then we bill later. And oftentimes, we're not billing the person, it's a third party payer system. We're billing their insurance or Medicare or Medicaid or what have you. So, your accounts receivable or your patient receivables is a very important tool to manage because you can provide the best care in the state. You can provide a lot of care in this. You can see a lot of patients, but if you're not collecting, if your patient receivables is going up every single period, the end of January, your patient receivables is X. The end of February, it's X times two, and it just keeps going up and up and up. You're not collecting that cash. That's a recipe for disaster. Another asset component may be pending reimbursements. You may have some payments that you know that are coming from an insurer that you haven't received yet. So that's a little different than patient receivables because it's coming directly from that insurance agency and it's maybe coming outside of a routine AR. That's something that you want to track as well because let me tell you, if you don't track that, odds are the insurance company isn't going to be beating down your door to pay you. So you have to keep track of any pending reimbursements. And then the last asset that I want to cover, because I think it does correlate to operations, is prepaid expenses. Very simple. They are expenses that you have already paid for, but you've not got the benefit yet. You've not received that future economic gain yet, but you paid for it. So that's an asset. You should be expecting that future economic gain in the near future. It's a very important asset to keep track of. The non-current assets you probably won't have a lot of exposure to, but the most common example would be the physical plant, the building, the furniture. Your company may have some intangibles. I doubt they have any patents, but they might. A lot of times, goodwill is a significant intangible. Maybe it would be some type of branding or what have you. The non-current assets I don't anticipate coming up as much as the current assets, but you should still be familiar with it. And it's possible that you may take over operations of a nursing home that has a pretty large note receivable, meaning it's a non-current asset on the books where the company or your nursing home has loaned out some money, maybe to a sister facility, and you should be expecting to get that money back at some point, and you would want to keep track of that. The liability side would be the opposite side of that coin. Everything that we just covered would be kind of the opposite. It'd be things that you owe, things that you're liable for. The two noteworthy liabilities here would be accrued payroll. It is certainly possible that you would have accrued payroll where the employees they have done the work, but the payment hasn't gone out yet. Now, if your accrued payroll gets too high, you probably won't have a lot of employees wanting to work for you, but it is something that is on the balance sheet that you kind of want to keep track of. What is really common now, unfortunately, would be an AP related to a staffing agency. That's something that you definitely would want to know of when you take over a new building, because if you take over the operations of a nursing home, and let's say you're not an astute operator, you don't even know what the balance sheet looks like, or you never ask for one or never see one, you may have a lot of accounts payable outstanding, meaning vendors like a staffing agency or even vendors like your nursing supplies or your raw food supply. You may have a lot of accounts payable outstanding and not know it. And then one day you may be in your office and the director of nursing comes and says, "We are completely out of wound supplies. We submitted an order to McKesson, and they said that we are in the arrears, and they're not going to send us anything." Well, by then it's a little too late to pull your balance sheet and see, "Oh yeah, we owe McKesson a lot. We have a lot in accounts payable. I'm reviewing the accounts payable component. We owe McKesson a lot of money for back invoices that we haven't paid. They're not going to send us any supplies until we get that paid up." Liabilities, just like assets, you have current and you have non-current. The accrued payroll and accounts payable typically are always a current liability. If your accounts payable moves to a non-current, meaning the same 12-month cutoff, if you owe vendors money over a year out, that's not good. That's probably not a company you want to work for, right? Non-current liabilities would be long-term. The most common would probably be the debt service for your nursing home. Would be like a mortgage or payment to the investor or what have you. So the non-current probably won't come up as much, but it's noteworthy. So once you have your assets and your liabilities, you take assets less liabilities, and what you have left is your owner's equity, like capital stock, retained earnings, additional paid in capital, maybe even some treasury stock. It depends upon the structure of your company. But the reason why that's important is because if you look at it from a very simplistic perspective, if you do that basic equation, assets minus liabilities equals owner's equity, you would want the owner's equity section to be positive, right? You would not want to add up all of the future economic gain and the future economic liabilities and have the liabilities be more. That would not be good. And ultimately that's going to negatively impact the quality of care that you can provide, and the company may have to sell at some point. All right, gang. So with the statement of cash flow being it's the third component of the set of financials, admittedly, I would be surprised if any company you work for would give you that type of exposure as the executive director. Um, they might, and many of you may move on to the VP positions and C-level positions. So if you haven't already had exposure to the statement of cash flows, I wanted to touch on it briefly because I do think it's something that you need to have some type of familiarity with. So the statement of cash flows, the main thing about the statement of cash flows, it will provide, it is pretty crucial for the nursing home to understand and manage its cash, right? When you work in an environment that we do with very small margins and where the we don't get to just close our doors, right? Like when a nursing home closes, typically it makes national news because it is that detrimental to the community and to the patients that they serve. And many times, the reason why the nursing home will go under is because they're not managing the financials and they're not managing the statement of cash flows. The statement of cash flow will help you understand if your nursing home has the appropriate amount of liquidity to continue its operations, meaning basically, can you cover your expenses? You know, and it is a very simple concept, but it's something that it's kind of hard to explain. But once you get it in the operations and the day to day, it sometimes just the daily operations can consume you to a point to where you don't feel like you have the time to review the financials, but you need to make time. The statement of cash flows has three components, and they're pretty self-explanatory. You have the operating activity component, investing activities, financing activities, and what goes under each component is pretty self-explanatory. The operating activities would be cash flow from operating, right? From taking care of patients, from billing insurance, things like that. The investing activities, the reason why I bring that up is because If you're working for a company and let's say you are privileged enough to see the whole company statement of cash flows, you would like to see positive cash flow because of the operating activities. If you have positive cash flow, but it's because of investing activities, that could be a little suspect. Like, why are they selling off assets so they can cash flow their operations? It would be like if McDonald's suddenly wasn't making any money off of selling hamburgers, and the money that they were making was from selling their McFlurry machines that are always broken, right? That wouldn't be good, because as the manager of that McDonald's, if that location isn't making money off of its operating activities, you probably won't be in business very long. And unlike McDonald's, we don't just get to shut our doors and go home. We're taking care of people. The financing activities also is critical, because if you are lucky enough to have that exposure, or you have the opportunity where maybe your RDO or CFO says, would you like to look at it, and just assumes you're like, no, that's fine, jump on that opportunity and look at it, because within the financing activities section, you can get a lot of insight into your company. For example, you would not want, it wouldn't be very healthy of a company if the majority of its cash flow is because it's just raising debt. It's just basically it's going into debt more and more and more just so it can cash flow its operations. That would be very detrimental to the long term health of your nursing home. And you can see that in the financing activities sections. If the change from your beginning amount of cash to the end amount of cash, say that period is a quarter, did cash go up or did cash go down? Well, you can see that from the statement of cash flows. Just as important as whether or not it went up or down, why did it go up or down? If your company had, or your nursing home had 500,000 in cash on January 1, and then it had 400,000 in cash on March 31st, the reason behind that change is just as important as why did it as that change. So with the financing section, let's say that you started out January 1 with 500,000 in cash, March 31st you're at 900,000 in cash. That sounds great, right? Who wouldn't want to increase their cash like that through one quarter? The issue is, if you look at the statement of cash flows, you go to the financial section and you see that it's because we took on some more debt just so we can get cash. That's not good. That's a kick in the can, right? The big issue with that is you're going to see interest payments on your debt. And based upon the governing body, based upon whether you're a public company or you're a private company, the interest payments could go in different sections. But for the most part, just think of it as, if you're taking on debt and you have an interest payment just like you do on your car, that's something that you'd want to know. I don't know how much exposure you would get to a statement of cash flows, but if you ever have the opportunity to review one for your nursing home or for your company, I definitely recommend that you dissect it. All right, guys. So we've covered the income statement, the balance sheet, the statement of cash flows. Did a brief dive into that. There are two more topics that I want to cover because they directly correlate to those financials. The first one is the general ledger. Now, the general ledger is very simple to understand. The general ledger should have every single transaction of your nursing home for that specific period of time. So when you look at your income statement, and let's say your income statement is for the month of January, associated to that income statement should be a general ledger. So anything that you look up on that income statement, anything from Medicare reimbursement to raw food expense, you should be able to go to the general ledger and then see every transaction that made up that account code. If at the end of January you've spent 30,000 in raw food, you should be able to go to a general ledger and see every single transaction that made up that 30,000 that made its way to your income statement. The general ledger is a tool that it can help you so much with operations because you should be able to see every single transaction. Okay, there are a couple good examples of this. If we think about it just from a very common sense perspective, how could it not be beneficial to have this report that shows every single transaction that your nursing home did with the invoice date, the vendor name, the posting date, meaning, when did it get entered into the system, and then the dollar amount that was either received or spent. Um, an example that I like to give is you can learn a lot from the financials of your nursing home and apply it to operations. It's actually what created my passion for healthcare finance, was trying to make it more than just bean counting. And let's say at the end of the month, you get your income statement and your raw food expense is 10,000 under budget. Well, if you are just a bean counter and all you care about is the profit of that nursing home, you may think, well, heck yeah, we spent less than budget. That is great. We're saving money. Good job. And then you just move on, right? But an astute operator who understands the financials and understands the correlation to operations and knows that that correlates to how we take care of our patients would see that $10,000 under on raw food and think, something's not right here. And then you would dive into it deeper. And then you would go to your general ledger and you would say, okay, well, on this income statement, we're $10,000 less than budget. Why? Then you go to your general ledger, you go to the raw food section, and you look through every transaction. And you can see, well, maybe we didn't buy enough food that we needed. Maybe there was an error with the processing of invoices. It may not answer the question for you, but it's going to give you some insight as to, hey, I need to investigate this further, right? If your income statement shows that you're 10,000 under on raw food, and then you go to your general ledger, and maybe it only shows, well, we only had 3 raw food orders this month, and I know that we should have 4, one for each week, and that's why we're under. Well, that is a tool that helps your operations, that will impact your quality of outcomes, because you go back to your food service director and say, how many orders did you place for raw food? If they say 3, well, you're supposed to have 4. That's not good. If they say 4 and your general ledger only shows 3, well, that's not good, because there's something missing between between the order, the invoice, and being processed. Maybe your food service director isn't getting the invoices. Maybe the vendor isn't sending them. Maybe the business office manager lost it. It won't answer those questions for you, but it will help you identify problems in operations. Another example is, and this one happened to me. We were drastically over 1 month in repairs and maintenance. So in morning meeting, I was going over the prior month financials, and I had looked and saw that we were drastically over on repairs and maintenance. I brought it up to my business office manager, who said, well, the director of maintenance said that we just had a lot of things break down that month. Okay. Sometimes what you'll find is an administrator who isn't astute with the financial side may just take that and move on. Maybe they don't care, or maybe a lot of times what I have found is sometimes when people aren't comfortable with the financial side of what we do, sometimes they can kind of put their head in the sand because they don't want to. I guess they don't want to show that they don't really understand the financial side. Maybe it's looks like it's a weakness. So maybe they just take that and say, oh well, we had a lot of stuff break down that month and move on. The astute operator is going to take that and say, okay, pull the general ledger. And if that is true, that a lot of things broke down, you should be able to see that on the general ledger based upon the vendors that we're utilizing, right? If you did have a lot of breakdowns and you see a lot of service repairs on that GL, that would kind of make sense. What I found was that we were drastically over because my maintenance director was utilizing a vendor who was not one of our key vendors because their prices really weren't in line with what they should be, and they didn't deliver. They basically were just a traditional, you show up, you pay with a card or cash or check, and you get the product. Well, the reason why I bring this up is because if I just would have took it on face value that, oh, we had a lot of repairs that month, move on, and not pulled the general ledger, not reviewed the vendors and the amounts, I wouldn't have seen that my maintenance director had taken 14 trips, leaving the building 14 times in 1 month to go to this vendor, which is not a vendor I want them to use because they charge too much and they don't let us purchase on account and they don't deliver. Think about that. That means on average, once every 2 days, this director of maintenance was leaving the building to go buy stuff that he should have been doing the appropriate ordering in the first of the month, not retrospectively leaving the building to go buy it. It's more than just about the dollar amount. That's an operational inefficiency when the employee is leaving the building on average, every 2 days. In addition, this was a rural nursing home. So he was traveling about 40 minutes both ways to go to this department store. And think of the potential liability. He's on the clock, right? But he's in his personal vehicle driving. There's a lot of opportunity for some unfortunate accidents to happen. All of that derived from reviewing the income statement, seeing the variance to budget and repairs and maintenance, pulling the general ledger, and dissecting it. It's not about just being over in that line item. It's about the correlation between your financials and your operations. The other thing I want to talk about is a chart of accounts. The chart of accounts is a very, very simple concept, but it can be made very, very challenging. Another class that I teach utilizes a textbook. The explanation for a chart of accounts is 3 pages long. It makes it overly complicated, and it's just not necessary. The chart of accounts is exactly what it sounds like. It would be a big report that shows all of the accounts for that nursing home. When I say accounts, I mean repairs and maintenance, dietary supplies, food supplement, dietary dishes, housekeeping supplies. It's all of the accounts, okay, that general ledger has. And the chart of accounts, think of it as a phone number. And the basic example that I always provide would be like if you take over the operations of a nursing home and your business office manager comes to you with an invoice and says, hey, our medical supply clerk just purchased a bunch of nursing supplies from McKesson, handed me the invoice. Where should I allocate this? Well, first off, if your business office manager is asking you that, that's probably not a good sign. But maybe she's new, and for the purpose of this example, let's just say that's fine. The chart of accounts would be the way for you to understand. Okay, this is nursing supplies. Where do nursing supplies go? Oh, well, they go to division number, whatever, department number, nursing, account number, what have you. For example, the division may identify that nursing home, like 141, 142, 143, 144, 145. If you're in a company that has 30, 40 nursing homes, each nursing home may have a different division number. Now, a chart of accounts could also have more than just division department account. They could have region, right? It could be that your nursing home is in the Indiana region, so then there would be a number to designate that. But at the end of the day, think of it as a phone number. So when that BOM comes to you with that invoice and says, "Hey, where do I code this?" There is a numerical identification on the appropriate allocation of that invoice. It may be division 141, department 100, meaning nursing. Maybe department 100 is nursing. Account number 600030, meaning supplies. So you can see that invoice from McKesson for nursing supplies has an appropriate allocation, meaning this building bought it, so it's building 141, division 141. It supplies for nursing, so it's going to be the nursing department, which is identified by department 100. And then they are supplies, which is identified by account number 600030 or what have you. That is hard for me to really explain how important that is. But we got to remember, we work in a very regulated environment, and we're getting federal funding and state funding and insurance money. The appropriate allocation is very important because we have to report back to the state and to the federal government, what are we doing with the reimbursement money that we received? And maybe an overly simplified example, but if that BOM allocates that nursing supply invoice to the wrong department, say they do division number 141, which is the appropriate division number, but instead of doing department 100 for nursing, they do department 300 for dietary, and then the account number is still the 600030 supplies. That's going to look like to Medicare and to Medicaid that you're not spending the appropriate amount of money on nursing compared to your peers. So it is critical to take those two tools, the general ledger, the chart of accounts, understand how they correlate together, and then use that to dissect your financials. All right, gang. So you have three assignments for this module. You have your normal voice thread, your thoughts for the week. Then you have a balance sheet assignment where you're going to dissect and compare two fictional nursing homes, look at their balance sheets, compare their assets, their liabilities, identify them. And then on your income statement assignment, you're going to dissect and interpret some information from an income statement. And you're also going to review the general ledger for that income statement to try to further dissect each line item. All right, guys, so for the balance sheet assignment for part one, you have a table and you're going to fill in the blanks of that table. And at the top side up here, you're going to have basically the question. Down here, you have the general ledger short name, like equipment. And then what will be given would be the general ledger number. So the general ledger short name, like equipment, correlates to that general ledger number. And then you're going to go to the actual balance sheet provided. You're going to find, based upon the short name and the number, you're going to find that line item, and then you're going to tell me, hey, this is how much it is, right? That part shouldn't be too challenging. Then you're going to identify, hey, is it an asset, a liability, short term, long term, what have you. On part two of your balance sheet assignment, you're going to further dissect it by briefly explaining the component that you recently identified. So for that example, right here, when you identified equipment, you need to provide an example right here. This won't be on the balance sheet. You need to provide an example. I mean, it could be on the balance sheet, don't get me wrong, but it could just say equipment too. And then you'd have to further identify what is a common piece of equipment that a nursing home may have, and provide an example of that. AR, similarly, you would want to identify, what is patient AR, what's the accounts receivable, what does it mean, and you're going to go through that for a couple of items that you recently identified. So on your income statement assignment, it's income statement and general ledger. And I know it looks like a lot because it's 5 parts, but it's pretty concise. You're going to go through the assignment, and you're going to look at the monthly income statement provided for Shady Acres Retirement Community. Okay, you're going to do a similar exercise as you did on the balance sheet, where you will dissect the revenue, operating expense, things like that. And then you'll provide an example of that item. Okay. And it should help you guys go through the income statement, get a little more comfortable with the income statement, understanding, revenue is on the top. Then you're going to have your labor related and labor and other operating expenses, fixed expenses, things like that. And then part 5, you're going to look at the general ledger to help understand and more closely examine the transactions that made up that expense category that you identified. So the example that we have here from your income statement and general ledger assignment, it is similar to the balance sheet one. You're going to have a fill in the blank and some short answer. Here's an example of that. And it may ask you things like where the balance sheet asked about equipment. This will ask about things specific to the income statement, like Medicaid days, Medicare days, raw food expense, things like that. What you have is a bigger chart of accounts here, because we have the division number that we talked about, the department number, and then the general ledger number. You'll go over to the income statement provided for Shady Acres, and you will go through it, and you will try to identify based upon the chart of accounts. So, for example, on Medicaid days, it says general ledger number 90310. Well, here's all of your chart of accounts. Division's 142. Well, right here. And then department is all zeros for days. Well, then you just found the monthly actual and you input it. You'll do that for a variety of accounts within the income statement, and then you're going to dive into the general ledger to provide some more detail. All right, gang. So that was module 6, the financials of a nursing home. Look, this module is if you have exposure to the financials, this module probably is a little too easy. If you haven't had exposure to it, it may be a little too hard. So with that being said, reach out to me. We can work through it together. If you have had exposure to financials and some of the in the weeds aspects of accounting, and you fly through it, great. If you struggle with it a little bit, that would be expected. Unless like your undergrad's in accounting, and that's fine. That's what I'm here for. Reach out to me. We'll work through it together. I'll see you in the next video. All right, future healthcare leaders, that is all for this module. Please comment below. Let me know what your thoughts are. Let me know if there's a topic that maybe we need to cover that I can add to our coursework. Also, let me know if there's something that you think is maybe off base and we need to change up. Until next time, I'm Brody09s.